Good day, students. Once again, I am back with another video on standard costing, and this is the standard costing question where we do the reconciliation, then where we do the income statement, budgeted and actual, then after do the reconciliation of the budget, vice versa the actual, or reconcile the budget to the actual income statement through the analysis of the variance. So here is our requirements. First, as I prefer to start with the requirements. Sometimes I forget. If I forget, I forget. Now, requirement number A says prepare a standard cost card for product soda and calculate the standard gross profit. The previous question on standard costing that I did, the standard cost card was given and the gross profit, or the standard gross profit, was already calculated as 30 rand, where previously it was 80 rand minus 50 rand, and that gave us 30 rand. If you did watch the latter video that I uploaded on standard costing, where the reconciliation was also done, reconciling the budget with the actual. B, we are to prepare a budget and the actual gross profit statement for the month of June in the year 2018. So now we are doing the budgeted and the actual gross profit, meaning we have to compile the income statement where we say sales minus the cost of sales, and we get to the gross profit. Then after, we are to prepare the reconciliation statement to reconcile the budgeted gross profit with the actual gross profit for the product soda, or for product soda for the month of June in the year 2018. So this is what we have at the back of our mind: the standard cost haircut, the budget and the actual income statement, and the reconciliation of the budget with the actual. Now, standard cost card is based on the budgeted information that we have, and before I start on that, let me read. Below is a normal budgeted production summary for product soda, which is produced as a single product by JKL TD. Now let me just scroll and look for some things here at the bottom that are very crucial. Okay. Then this is the product produced by JKLTD. The company operates a standard absorption costing system. Very important to know which system is our income statements compiled under, which system is the company using, because there are two, which is the standard absorption costing system and the marginal costing system. So now in the case of the marginal, which I've not done a question on that, except some of the questions I did, in fact some questions where there is absorption, where there is marginal costing. In the absorption costing, we say sales minus cost of sales. In the marginal, we say sales minus variable manufacturing cost. We are given our production and sales budgeted as 480,000, meaning there is no opening and there is also no closing inventory, because what we plan to produce is what we plan to sell, all of it. So now budgeted production is equal to budgeted sales. We are then provided with the production costs information regarding the direct material, direct labor, variable manufacturing overheads, and fixed manufacturing overheads. Then let me just proceed because I'm looking for something that is not here. Variable overheads absorbed based on a predetermined direct labor hour rate, meaning our variable manufacturing overheads are based on direct labor hours, and we already have our direct labor hours as 432,000 hours. Then after, while the fixed overheads are absorbed based on the predetermined overhead rate per unit of output, meaning our fixed overhead should be based on the number of units that are manufactured while our variable overhead should be based on the number of labor hours that we budget to spend in order to manufacture the 480,000 units. So now, having that in mind, read the last sentence before I go to the actual information. The budgeted sales revenue is 16 million. This is the total revenue that we expect to receive when we sell what we expect to sell. So now that means our selling price per unit will be the 480 after it has been divided with that 16,400,000 rands. So now we have 800,000 rands. And if we divide this by 480,000 rands, we get to know that our budgeted selling price is 35 rand. So now that will be at 35 rand per unit, 35 rand per unit, meaning the selling price is 35 rand per unit, such that the total sales revenue is 16,800,000 rands. So now remember, when we are compiling our standard cost card and the gross profit per unit, we are doing the first requirement, compiling the standard cost card. Our standard cost card, that is where we deal with the cost per unit. We start with the sales per unit or selling price per unit. Selling price per unit. Our selling price per unit is already calculated as an amount of 35 rand. Then after, we will have our cost per unit. Cost per unit. Our cost per unit is made of direct material. And after direct material, we know that there will be direct labor. And after direct labor, we know that there will be manufacturing overheads, variable overheads. Our variable overheads. Then after, we'll have our fixed overheads. And all this must be calculated to per unit. Then after that, this will give us standard gross profit per unit. And this is the standard gross profit that will be used to calculate standard gross profit. This will be used when we're calculating the sales volume variance. Now let us look for all the cost elements that we need to record in our standard cost card. Standard cost card, that's where we allocate or calculate our information per unit, and the labor hours per unit, and the material required per unit, and the cost of material per kg, and all that stuff is per unit. We have our direct material as the first component of production, and we are given 672,000 kgs, which is at 8 rand 20 cents per kg. So now this is per kg, and if this is per kg, meaning now we need to go and we allocate these kgs where it is supposed to be in our standard cost card. Therefore now this material is 8 rand 20 cents per kg. So now that is the kg we expect to buy our material at. Remember, we need to multiply by the required kgs per unit in order for us to get to the cost per unit. This will be cost per unit. In order for us to get the cost per unit, we need to multiply by the required kgs to complete 1 unit. But let us check the given information if can we be able to do so. Now, we are given the material that we budget to spend in order to manufacture what we want to manufacture. Then the cost of each material is 8 rand 20 cents, meaning we can be able to get to the total cost of material, and the total cost of material will be 672,000 kgs. Term this by 8 rand 20 cents per kg, meaning our total material will be 5,510,400. 5,510,400 is our estimated total cost of material that we expect to spend in order to manufacture that 480,000 units. Therefore now, if we have this total, what we can do is to take the total and we divide it by the number of units that we want to manufacture, because this is the total cost of material that will be incurred in order to manufacture the total 480,000 units. So now if we divide the total cost of material with 480,000 rands, we will get to our material cost per unit. So now that will be the material cost per unit, divide this by 480,000 units, it gives us 11 rand 48 cents. So now 11 rand 48 cents becomes the cost of material per unit here, 11 rand 48 cents. So now we know there was something that was multiplied by here which we don't know, and that was the kg that we multiplied in order for us to get here. So now we are looking for this kgs being the unknown. Then we say the price divide the price per unit divide by the price per kg. The price per kg being 8 rand 20 cents, divide this by 8 rand 20 cents. Remember, mathematically, rand will cancel another rand. So the answer that we get will not be in rand, because from a mathematical perspective, r will cancel another r whenever you divide. So now meaning whatever we get will be the number of required kgs to complete 1 unit. It will be the number of required kgs to complete 1 unit. Then now that will be 1.4 kgs that are required to complete 1 unit. So we have that 1.4 kgs that are required to complete 1 unit. I just rounded it off to 1.4. So now we require 1.4, which is 1.35 kgs if you want to do so, depending to the instruction in terms of how to round off. So now that will be the way in which we calculate our material in terms of the kg that are required and the cost per unit. Then now we go to our labor calculation with regards to the standard cost card. Let us go and check how much or what are we given regarding labor. Regarding labor, we have direct labor and we are given 432,000 budgeted hours, meaning we budget to use or to spend 432 hours or to take 432 hours in order to manufacture the 480,000 units. And we expect to pay our employees 9 rand per hour. So now that 9 rand per hour is not per unit, it is per hour. So now the 9 rand will be here and we need to multiply it by the required hours in order for us to get to the cost per unit. Now let us check if which one can we get first. In this case, what we are given is the rate per hour that we budget to pay our employees and the total hours. And if we multiply this, it will give us the total material cost to manufacture 480,000 units. So now it will be 432,000 multiply this by 9, and it gives us 3,888,000. 3,888,000. This is the total cost of labor that we expect to pay in order to manufacture the 480,000 units. So now meaning if we divide the total cost with the total number of units that we want to manufacture, this will give us the cost of labor per unit. So now we divide this by 480,000 units. This will give us 8 rand 10 cents, and 8 rand 10 cents will be the cost of labor per unit. So now we go and we substitute this in our standard cost card. Remember, this column is the column of the cost per unit. That is where we are. That is the column of the cost per unit. Just to draw a line here, separate our cost. This column is the cost per unit. So now we have calculated our labor as 8 rand 10 cents, and once again there was a rate that was multiplied by hours, and that gave us the cost per unit. And now what are we looking for? We are looking for the hours it takes to complete 1 unit if the cost per unit is 8 rand 10 cents. So 8 rand 10 cents, divide this by the rate of 9 rand, we discover that it takes 0.9 hours to complete 1 unit. So now that will be the accurate calculation regarding the labor hours. When it comes to overheads, remember overheads are also based on labor hours, so it will be 0.9 hours times this by the rate of the overheads, because the variable overheads are based on direct labor hour rate. Remember, variable overheads are absorbed based on the predetermined overhead rate based on labor hours rate, while the fixed one are based on the cost or on the output of production. So now, meaning coming back now, we have to say, okay, what are we looking for? We are looking for the cost per unit. We are also looking for the rate of the variable overheads per labor hour. Then going back and checking those numbers once again, we have our variable manufacturing overheads, which is 950,000 rands 400. And we know that the total budgeted labor hours is 432,000 hours. And if we divide by hours, we will get our rate per hour. But if we divide by the units, we will get our rate per unit. So now let me do both of them and just prove to you that either way you'll get to the same amount. We have 950,400, divide this by 432,000, and this is 2 rand 20 cents. That is the 2 rand 20 cents, it is per labor hour. So now, meaning if it's per labor hour, meaning it's not per unit, that will mean it is 2 rand 20 cents here per hour. 2 rand per hour. Therefore now, if we say 2 rand per hour times this by 0.9, it gives us 1 rand 98 cents. So now that 1 rand 98 cents of the variable overhead cost per unit should be the same when we take the cost of 950,400, we divide it by 480,000 units. Therefore now we get the cost per unit, which is the total in the last column. Then we say 950,400, we divide this by 480,000 units. Therefore now we get to 1 rand 98 cents. 1 rand 98 cents is the cost per unit because we divided by the units. Therefore now, if we had taken the second approach that I've just calculated, we're going to say 1 rand 98, divide this by 0.9 hours. And if we do so, that will give us the 2 rand 20 cents. In case the 2 rand 20 cents, I did not substitute it immediately. So now it was going to be 1 rand 98, divide this by 0.9 hours, and that will still give us 2 rand 20 cents as the rate per hour now. So now either way, you'll still come up to the same calculations. So now make sure that you master this in all dimensions, because you can be assessed at any of the dimensions. Our fixed overheads are absorbed based on the output per unit, based on the predetermined rate per unit, meaning the fixed overheads is not based on hours. No. It is based on production, and our production is 480,000 units. So now we have the total, and we need it per unit 480,000. Then this will give us we have 3,043,200. Divide this by 480,000. This gives us 6 rand 34 cents, and the 6 rand 34 cents is already per unit, and our fixed overheads are based on the output of every production. So now based on production, that will be 6 rand 34 cents. Therefore now I have calculated all of my cost per unit, per hour, or per kg. Then I can say 6 rand 34 cents plus 1.98 plus 8 rand 10 cents of labor cost plus 11 rand 48 cents of material per unit, and this gives me a total of 27 rand 90 cents. So now 27 rand 90 cents minus 35 rand of the selling price, this gives me 7 rand 10 cents, and 7 rand 10 cents now becomes the gross standard or standard gross profit per unit. standard gross profit per unit. So now this is in response to the first requirement. Then now I have to go and do the second requirement, which is the budgeted and the actual gross profit. Budgeted and actual gross profit. Or budgeted and actual income statement, if you want to say so, because I'm compiling income statement here, calculating gross profit from income statement. Then now we start by saying budgeted and actual. It doesn't matter which income statement you start with, budgeted and actual. I prefer to start with the budgeted because in costing we budget before the actual production. Then we have our sales, and our sales budgeted were 16,800,000 rands. Now this is 16,800,000 rands. Please be mindful of this. In the previous question they said all stocks are valued at standard cost. That was the previous question I did. Please do go and watch that video. But for this one they were silent, meaning stocks is valued according to the cost that relate to that period, and I'll say to that period. Now we have our sales calculated for us 16,800,000 rands. Then we need to say minus cost of sales because we are using absorption costing system. Sales less cost of sales, and my cost of sales will be made of opening inventory. I always want to say opening inventory, either is there or not. Opening inventory plus production, and my production cost is made of 3 or 4 elements. It is direct material, it is direct labor, it is variable overheads. I hope I'll have space here. Variable overheads, it is fixed overheads, fixed overheads, then less closing, then we less closing, then this will give us gross profit. Luckily I had space. This is the last line. So now this is how this will look like in terms of the income statement material, in terms of the income statement. Now please also be mindful with regards to material. I want to just highlight again with regards to material. Material that we are focusing on is material that was used. This is material used. Let me specify. This is material used. And material used is made of 3 calculations. It is made of the opening material, which might be valued at the opening cost of the previous period, plus purchases of material, minus closing of material, and the sum of these 3 become material used. I want to always emphasize this, although in this question it is not here. I might develop a question that has the opening, purchases and closing so that you can see the bigger picture. But also in the previous question I did partly highlight on that. Now in this case there was no opening and there was no closing. All that was purchased was all used. So now hence the calculation of the material used then becomes again very simple in this scenario. When we say opening here, we are referring to finished goods. This is the opening finished goods, not the opening of raw material. So you might be given opening of raw material, this is finished, and when you say closing here, this is closing of finished, because opening and closing of raw material would have been accounted here when you were calculating material used. So now also please be mindful of that additional information in case in your level of assessment gets to be assessed. Now let me go and continue with my calculations. Then my material, I think I already did some calculations, and I'm not going to show workings here because of space purposes. My material, I will just do my calculations here. We bought material as 678,000 at 8 rand 20 cents. Therefore now the sum of that will be 8 rand 20 cents. Multiply this by 672,000, and this gives 5,510,400. 5,510,400. So this is 5,510,400. Then now we go to our direct labor cost. Our direct labor cost is given again as total hours and the rate budgeted per hour. Then the same scenario will apply. 9 rand times this by 432,000 hours. This gives a total of 3,888,000 rands. Then we go and we paste our labor, 3,888,000 rands. Our budgeted variable overheads are already given in total 950,400. Just copy and place 950,400, and together with the fixed overheads that were given in total as 3,043,200. 3,043,200. So now that will be our fixed overheads, 3,043,200 rands. Then now we go to the next part of the budget, which is the closing inventory that is not there because all that was produced was all sold. And the opening also, that was not there because all that was produced was all sold. There was no opening inventory. Therefore now let me then draw a line to calculate my production cost. Therefore now my production cost will be made of 3,888,000 plus 5,510,400 plus 950,400. Then this gives me a total of the budgeted of 1 million. Let me just recalculate the cost of those sales. We have 5,510,400 plus 3,888,000 plus 950,400 plus 3,043,200. Then that is 13,392,000. That is my production cost, and my production cost is equal to my cost of sales, which is 13,392,000 minus 16,800,000. That will give me the gross profit of 3,408,000. 3,408,000. That is the gross profit budgeted. Then I go and do my actual income statement based on the actual figures. Then the actual information provided that during the month of June, the actual production and sales were 440,000, meaning we actually manufactured for 40 and we actually sold all that was manufactured. Again, under the actual budget, there was no opening and either closing inventory of some sort, either the material or the finished goods. Then we have direct material, which is 662,120, and we are given already the total cost. Please be mindful of this. In the budgeted information, I want to give you the highlight of that. If you look at the budgeted information, we are given with regards to material, the kgs, which is the same kg, which is the same as the actual kgs, but we are given cost per kg with regards to the budgeted information. But here we are given the total cost of material, not the cost per kg. So now if we want to calculate the kg cost, we will say the total cost divide this by 626,120. That will give us the cost per kg. So now that will be 626,120. It will be 6,261,200. 6,261,200. Divide that by 626,120. Then this gives me 10 rand, meaning the actual cost of material per kg is 10 rand. But what we budgeted was 8 rand and we paid more than we anticipated. So now the variance in terms of the material price will definitely be unfavorable. So now in this case, we are, as I say, that we are already given the cost 6,261,200. Just copy that and paste as it is, 6,261,200. Then we go to the next cost, which is or should be labor. And again, our direct labor, we are given the hours as previously, and we are given the total cost again. And if we want the rate of labor per hour, it will be 3,898,400. Divide this by 389,840, and this gives me 10 rand again, 10 rand of the actual direct labor rate. So now that being 10 rand, therefore now meaning we compare what we budgeted previously. We budgeted 9 rand of labor per hour, but we actually paid 10 rand, and again this variance becomes unfavorable. But for the sake of the income statement, we just take the total as it is, 3,898,400, and we paste that figure, 3,898,400. Then we go to the variable overheads. Variable overheads, they normally give us as a total figure. There is variable overheads 867,400. Then this will be 867,400. And again, I want to calculate my rate per labor hour with regards to the overheads that are variable. My variable overheads will be the total divided by the actual labor hours. And my total variable overheads is 867,400. Divide this by actual labor hours of 389,840. This will give me the variable overhead per labor hour, because variable overheads are based on labor hours. 867,400. Divide this by 3 million, or 389,840, and this gives me an amount of 2 rand 23 cents, if I may say so. But I prefer to take all the at least to 5 decimals, because the rounding off was not specified. 502 preferable when it's not clearly specified, but 2 decimal can also be okay. And the penalty on the rounding off will definitely not be there. Therefore now that will be the variable overheads per labor hour. Then if we compare with what we budgeted previously, we calculated, but it did not show all the calculations, but it could have been that amount divided by the labor hours. And let us check how much could we have budgeted per labor hour. 950,400, divide this by 432,000 hours, and this was 2 rand 20 cents. Yes, we did calculate previously. So budgeted was 2 rand 20 cents per hour, but actually we incurred 2 rand 23 cents. So the variance again will be unfavorable, also with the variable overheads. Then we go to the fixed one. The fixed overheads or manufacturing overhead is 3,002,480. 3,002,480. It will be 3,002,480 rands. So there is also was no closing inventory, and there was also no opening inventory. Then I can get to my production cost in total, which is equal to my cost of sales. Then after we start by saying 6,261,200 plus 3,898,400 plus 867,400 plus 3,002,408, and this gives me a total. Just confirm the calculations again. We have 6,261,200 plus 3,898,400 plus 867,400 plus 3,002,480. 3,002,480. Then this will be equal to a total of 14,029,480. Then we minus the sales, which we don't know yet how much is the amount of sales. Let me go and check the amount of the actual sales. The amount of the actual sales given to us as 17,600,000 rands minus 17,600,000 rands. Then let me go and record my actual sales, 17,600,000 rands, and my cost of sales being 14,029,480. That is my cost of sales, and my gross profit comes to 3,570,520. So this is my gross profit actual. Then now from here I will then be doing the variance, and when I'm done with the variance, then my budget will reconcile to actual. Then I start with the variance, and with the variance we have direct material, and regarding direct material we have the price. The price is the standard price minus the actual price, times this by the actual quantities that were bought. Our standard price of material is 8 rand 20 cents, and the actual price of material was 10 rand. So 8 rand 20 cents minus 10 rand times by actual quantities that were bought, and actual quantities that were purchased are also given to us. Actual quantities that were purchased 626,120. 626,120. Then this will give us an unfavorable variance. 8 rand 20 cents minus 10 cents times this by 626,120. and the variance is unfavorable variance. And this unfavorable variance is 11,270,016 to 70.16. That will be an unfavorable variance. Then after that, we will have our material usage. Usage is standard quantities, and our standard quantities is based on actual production. Standard quantities, we know that we actually manufactured 440,000. So now if that is what we manufactured, therefore now we need to say how many kgs were required to manufacture what was manufactured. It is 1.4 kgs. So now we say standard 1.4 per unit times by 440,000. It gives us the standard quantities of material that are required to manufacture what was already manufactured. So now the standard will be our standard quantities of 6 million or 616,000 kgs minus standard quantities minus actual quantities. Our actual quantity that we used all that was targeted to be used. So now it will be 626,120 once again. It will be 626,120 kgs. Times this by the standard price, and the standard price being 8 rand 20 cents. Then we say standard minus actual 626,120. Again, we get to an unfavorable variance times by 8 rand 20 cents. This gives us unfavorable of 82,984. So now the sum of the two will give us the net of this variance. So now we add the two variants, 11,270,16. It gives me the total of an unfavorable variance of 121,000. This is adverse. This is adverse, meaning unfavorable. And this is also adverse, meaning unfavorable. Variance that I should have started with is the price. Then the price being the selling price, or is the sales variance, which is the price and the units. Sales, where we start with the price, and the price of the selling price that we had, which was budgeted, was based on the 16 million, and that price was 35 rand. If you remember, 35 rand, where we said 16 million budgeted divide by unit that we budget to sell, that gave us 35 rand budgeted. So now let us go and we record the budgeted selling price of 35 rand minus, we don't know how much was the actual selling price yet. Then let's go and check in our actual information. Actual information told us that we actually sold inventory up to the value of 17.6 million. And this 17.6 million was the sale of 440,000 units. So now if we divide this by 440,000 units, we'll get to the price at which each of the unit was sold for. 17,600,000. Divide this by 440,000. And this will give me 40 rand, meaning this variance will be very favorable because we sold our units at a price more than what we anticipated to sell them, or more than what we budgeted to sell them at. Then we multiply that obviously by the number of units that were actually sold. So 40 minus 35 times this by 440,000 will give 2,200,000 rands. 2,200,000 rands, and this variance will be favorable. Then we come to the sales volume. The volume, now we have what was budgeted, which we budgeted, what actually took place, which we actually sold 440,000 units. instead of selling 480,000 units. In terms of the units, our variance was unfavorable, and we multiply this by the standard gross profit. Standard gross profit per unit was 710 cents. Please don't forget that. So we multiply this by 710 cents, and it will give us an unfavorable variance because we sold less units than we anticipated, though we sold less at a higher price. Therefore, 440,000 minus 480,000, then multiply this by 710 cents, and this gives a total of 284,000 rands, and this is unfavorable. Then again, I look for the sum of the two variants because they are all sales variants, plus 2,200,000, and this gives me a favorable net variance of 191,000 or 1,916,000. 1,916,000, and this variance end up being favorable, the net of the sales variance. This is the sales variance, so their net end up being favorable. Then after I go now to the labor variance, then we go to the labor variance. We start with the rate. The rate of labor that we anticipated per labor hour was calculated in our standard cost card. Our standard cost card, we anticipated that our laborers will be paid 9 rand. I think this was given. Then we record the 9 rand standard rate of 9 rand. Then we say 9 rand minus the actual rate. And we have to go and look for the actual rate in terms of how that can be calculated. And I think we calculated it to be an amount of 10 rand. We calculated an amount of 10 rand. Just to confirm that our labor, we had actual total and actual total cost and total hours. We say the total cost divided by the total hours of 389,840 will give us the cost per labor hour. 3,898,400. Divide this by 389,840. This will give us 10 rand actual labor cost per hour. So now that 10 rand will be the one that we now record in this variance. 9 rand minus 10 rand, term this by the actual labor hours. And our actual labor hours in total are already calculated as the total of 389,840. 389,840 is what to multiply with actual hours. 389,840 minus 9 times, so this will give us the same 389,840, but this variance will be unfavorable. We spent more than we anticipated. Then we go to labor efficiency, and our labor efficiency is the standard hours minus the actual hours. Remember, actual hours have not changed. 389,840 is our actual hours. Term this by the standard rate being 9 rand. Now we need to know that it takes 0.9 hours to complete 1 unit. That is our standard hours per unit. We expect that employees will take 0.9 hours, meaning 90% of the hour to complete 1 unit. Then we multiply this by the actual production, 440,000. Standard required term by actual production, that gives us the standard hours in total, which our standard hours is 396,000 minus the actual hours of 389,840. Then we multiply this by 9 rand, we get 55,440. 55,440, and this variance is favorable. And again, we look for the net of the two because all these are labor variance. Then we say minus 389,840. This will give us an unfavorable net variance of 334,400. this will be unfavorable. This will be unfavorable. This will be unfavorable variance. 334,400. Then we go to the next variance, only two variants that are left, then we totalize and reconcile. Then we go to variable overheads. Our variable overheads, we have the rate, which is the standard rate, then after we have the efficiency. Then our rate, we go and look for the rate, which was 2 rand 20 cents, and the actual rate was 2 rand 22,502. If you remember my rounding off, the budgeted was 2 rand 20 cents, and that is exactly what it is. And actually we calculated that one. How did we calculate that? We divided the total variable overheads by the base, of which the base is labor hours 389,840. It is 389,000. It is 867,400. Divide that by 389,840. And this gives us that figure exactly. So we minus this by 2 rand 20 cents just to make sure that is very accurate. Then we multiply by the actual hours of 389,840, and this will give us the variable overhead variance in terms of the rate. Then let's go and paste that figure. Then it will be times this by the actual hours 389,840, and our variance will be 952. I'm not going to round off the total. So now the variance will definitely be unfavorable. We paid more than what we anticipated to pay per labor hour. Then we come to the efficiency, which is standard hours. Standard hours does not change, 396,000 as calculated previously in the direct labor, minus actual hours 389,840, times this by the standard rate being 2 rand 20 cents. Therefore now that will be 396,000 minus 389,840 equals times by 2 rand 20 cents, and it gives me a total of 13,552. 13,552. This variance is favorable variance. So now we have then calculate the net of the two variants, check which one or what will be the net. Then we say minus 9,000 or 9,752. 9,752 9,752. Then this will give us a total of 3,800. So now that will be the net of 13,552 and 9,752. 3,800 is the correct amount, and this is favorable. This is favorable. Then we go to the last variance, which is the fixed overheads. Fixed overheads. Our fixed overheads, it is made of the fixed overhead expenditure. We start with the fixed overhead expenditure, which is budgeted fixed overheads minus actual fixed overheads. That is very simple variance that everyone should be just getting that 1 mark. Budgeted fixed overheads in total were 3,043,200. 3,042,200. 3,043,200. And we go and we look for the actual 3,043,200. Actual fixed overheads was 3,002,480. 3,002,480, and that variance will be 3,043,200 minus 3,002,480. This will be a favorable variance of 40,720. Favorable. Then we go to the fixed volume. Fixed overhead volume. Remember, I have fixed overhead, so I don't have to be repeating that, hence I'm just saying volume. The fixed overheads is based on the actual production, meaning the number of units. 480,000 that was budgeted minus 440,000 times by the standard fixed overhead per unit. Standard fixed overhead per unit was 6 rand 34 cents. So now that will be the 6 rand 34 cents we multiply with. We multiply that by 6 rand 34 cents. Then this will give us our variance. 480,000 minus 440,000 is 40,000 times by 6 rand 34 cents, and this is 253,600. This is what we're supposed to have, or this is what we actually sold, but this is what we budgeted. So now that variance again becomes unfavorable. Therefore now that will be unfavorable variance and it will be negative. Then we strike the net of the two variance, and if you want you can just say budgeted of or budget for no, even if you say actual and minus budgeted, it doesn't matter as long you know either the variance is unfavorable or favorable. This one will be unfavorable. Then now we strike the difference of the two variance, which is 440,720 minus 253,600, and that will give us the net as 187,120, and that one is favorable. So now when the variants are complete, very easy, then now you can start doing the reconciliation. And reconciliation, remember, it starts with the budgeted profit, and our budgeted profit is 3,408,000. It is 3,408,000. 3,408,000. Then now we go to all the variants. The first one was unfavorable. Then we say minus 121,000. Second one was favorable, plus 1,916,000. Third one was unfavorable, minus 334,400. Next one is plus 3,800. Then after we have 187,120, and that will be the last part, just to reconfirm and recalculate that figure to make sure that it gives us the actual profit. Budgeted 3,040,000 or 3,408,000. We minus 121,000. We plus 1,916,000. Then we minus 334,400. Then we plus 3,800. Then we plus 187,000. 187,120, and this was our last part of our variance, and that variance was unfavorable. And let me just reconfirm those, make sure that it's really reconciling. Here is our actual profit, and now let me do it individually. Let me do this individually. 3,408,000, and the first variance was the sales variance. Let me just go and check my sales variance. My sales variance was favorable, 2.2 million, then plus 2,200,000. Second variance was 284,000, and it was unfavorable, minus 284,000. Then the next one is 1,127,284, which was a negative, then minus 1,127,016, 1,127,016. Next one is minus 82,984. Yeah, these two variants were supposed to be added together. I'm noting that one now. Then we come to the next one, which is our labor variance. We minus 82,984, 82,984. I just want to confirm. Then we have minus 389,840, and plus 55,440. 55,440. Then we deduct the next one, which is 9,752, and 9,752 is minus, was unfavorable, and we plus the 13,552, 13,552. Then we go to the last variance, which is favorable, plus 40,720, 40,720. Then we deduct the last variance of 253,600, 253,600, and that gives us 357,520, and that 357,520 is our actual profit. So now let me just come here and make a correction of the first variance, because it's the one that made my calculations not to be accurate. So now that will be how you do your variance. Then this variance is 1,127,16 plus 82,984. This was 1,210,000. I said 121,000. 1,210,000. Yes, that is why this was not balancing. Now, in closure, meaning now we start by saying budgeted profit, though I should have left space, budgeted profit, and my budgeted profit is 3,408,000. Then after I minus where is unfavorable, I plus where it is favorable. Then after this will give me the actual profit at the end. And I have seen that my actual profit came to be accurate, and it is 3,570,520. 3,570,520. 3,570,520. And just now, to ensure that the calculations are very accurate, let me calculate now with the accurate figures. We have the 3,408,000, just to make sure, 3,408,000 minus 1,210,000 plus 1,916,000 minus 334,400 plus 3,800 plus 187,120. 1, 2, 3, 4, 5. Yes. So now with that being counted for, it should be giving us the same amount, and I don't know why it doesn't, because I've proven it. 3,408,000 minus 1,210,000 plus 1,916,000 minus 3,334,400 plus 3,800 plus 187,120. Let me check, where did I do something wrong? Let me check. 2,200,000 minus 284,000, 1,916,000. That one is right, and it is favorable variance. Just want to test. We have 389,840 minus 55,440. This is 334,400, because 389 was unfavorable, and so that will be unfavorable, correct? Then we have 13,552, which is favorable, minus 9,752. The net becomes 3.8 favorable variance. And the last one is 40,000, that is favorable. So this one should be unfavorable. Yes, the last one should be unfavorable. So yeah, I've seen that is the only last part. The last one, because the 256 is unfavorable, so the net should be unfavorable. 3,408,000 minus 1,210,000 plus 1,916,000 minus 334,400 plus 3,800 minus 187,120 minus 187,120. Let me just deduct this from 357,0520. Now let me then leave it like that, because it still does not go to where I want it. 253,600 minus 40,720, and this variance is 200. It is 212,880 to 12,880. 3,408,000 minus 1,210,000 plus 1,916,000 minus 334,400 plus 3,800 minus 212,880. Yes, then yeah, I've corrected all this small calculation that I could not get my answers for. Perhaps you have identified before that I've perhaps done some small mistakes. So now when we calculate from the budget minus the variance that are unfavorable plus those that are favorable, it should always bring us into the actual profit. And we have tested previous question, can also check, and also in this question we get to the same amount. Now with that, guys, let me say thank you, bye bye. Hope you have enjoyed and got something on this video. God bless you. Bye bye.